our role is to help people understand financial planning principles and make informed decisions. So we're an educative service. We're certainly not there to provide advice or recommendations, but hopefully help people become better informed to make better decisions throughout their life on financial issues. And of course understand the Social Security part of their retirement plan and very basic taxation information as well. Just the usual disclaimer, the presentation today is purely meant as a guide only and shouldn't be considered as advice or recommendations for anybody. Centrelink's role is to provide assistance to people in a wide range of situations throughout their life, starting out when people come in and have a newborn baby, to people looking to study, looking for work, raising families, perhaps becoming disabled and looking for work again, or perhaps coming up to retirement. So all these life events, we call it, and we have various assistance available to provide support to people during these situations. The age pension is probably the one that we're most renowned for being responsible for, and the age for men has been 65 years old for all the time, I guess. The age pension is actually over 100 years old as well, and the age pension age for women is gradually going up as we speak. Currently, you have to be 64 years old or anyone born in 1946 has to be at least 64 female to get the age pension. But once females, their date of birth comes to after the 1st of January 1949, then as the same as men, they'll need to be 65 years old to be able to access the age pension. And you may recall in the budget last year, it was announced that there would be a change for people after 1952, that they would need to be 67 years old, either female or male, or gradually going up from 65 to 67 years old. Now, one of the common situations I see, and perhaps you may see as representatives of the financial and superannuation industry, is people often don't actually get to their retirement age. They can quite often finish early for one reason or another. And they look at a couple of choices, whether they might be supporting themselves financially, or perhaps they look at, well, is there anything that Centrelink might be able to help me out at this time? So that's often one of the reasons people are referred to see an FIS officer, being made redundant, or perhaps getting some medical issues that might mean that they'll have to cease work due to medical grounds. So, or people just reducing back their hours of work, so they might think, oh, well, perhaps I might be eligible for something like a healthcare card. So the disability support pension, way back when it was called the invalidity pension, but over years it was decided, look, this is a payment that's to help people who may still be able to support themselves partially through work, etc. So it's a support to people who may have illness or disabilities that means that they cannot fully support themselves. So the criteria for that, you have to be over 16 years old, but not age pension age. You have to have a medical impairment. That means you're unable to work for at least 15 hours a week for at least a 2-year period, or unable to be retrained during that time. People can stay on disability pension when they go past age pension age, so they have to be under age pension age to claim the pension, but sometimes people may stay on that pension after turning age pension age, and that could be for a number of reasons. They could be getting some services through the employment agencies that are available on the disability pension, but not with age pension, or perhaps sometimes people may not have the right number of years residence to get an age pension. So a couple of reasons, but mostly people will transfer onto age pension. Other support that's available for people who are under age pension age, for people who are providing constant care to a family member generally with severe disability or a medical condition, so carer payment. So it's something where people are unable to, again, be able to fully support themselves because of their responsibility for caring. So they need to be working less than 25 hours a week, and that includes travel time as well. We have a supplementary payment called carer allowance. It could also be payable, so sometimes people may get both carer payment and carer allowance. The care allowance isn't means tested, whereas the carer payment has the same rates of payment as age and disability pension and the same income and asset thresholds. So there could possibly be people who are needed to provide care after hours and on weekends and so on, even sometimes coming home for lunch, but they're not necessarily providing constant care and attention. Other payments available if people are looking to study. If you're under 25 years old, you're looking at youth allowance, and that often depends on the income of the parents or the main parent in the family, unless they can get an exemption for other reasons. If you're over 25, you're looking at study payment if you meet the minimum requirements for study load, and study if you're of Aboriginal and Torres Strait Islander background. People with children, there has been a change to parenting payment in recent years. It's available if the age of your child is underneath a certain limit. If you're a partnered person, the dependent child has to be underneath 6 years old for you to claim parenting payment partnered. If you're a single person, the dependent child has to be underneath 8 years old. If your children are older than those limits, then the other payment available would be the New Start allowance, but with the recognition that you have some caring responsibilities that mean that you're perhaps not able to do the same amount of activities or looking for work as someone without those caring responsibilities. Tax benefits, way back when, years ago, it used to be called child endowment and then family allowance, and in recent years it's family tax benefits. Looking for work. So again, slight difference in the payments depending on age. If you're under 21 years old, you're looking for work, you'd be looking at youth allowance. Over 21 years old, you're looking at New Start allowance. So the criteria for the payment is you're unemployed or working part-time and you've got a capacity to work and you meet the required residential qualifications, which is a minimum of 2 years residence in Australia. Those of workforce age are expected to look for work if they are able, so we create or draw up for every individual on New Start or Youth Allowance looking for work something called an employment pathway plan. We used to call it an activity test, so similar thing. People are required to do a certain activity in return for getting the payment. So that's usually looking for a certain number of jobs per fortnight. It could be doing a certain amount of training that will bring them up to a level of being able to look for work with a few more skills, or it could be getting some work experience again to build up a certain skill level by either a program called Work for the Dole or even voluntary work. Voluntary work as a program is accessible for people under 55 only after a certain time. They must be looking for work and doing other things before they are given the opportunity to use voluntary work as part of their activities or part of their employment pathway plan. But if you're over 55, the activity requirements could be utilised, or the voluntary work requirements could be utilised straight away, and that's voluntary work of at least 15 hours a week, or paid work of at least 15 hours a week would meet the requirement, or a combination of both of those. But there is still a requirement if someone comes in and claims New Start after age 55 and they're doing the voluntary work option, that they still must remain connected with one of the Job Search Australia providers, and they must accept suitable offers of employment and attend all referrals for interviews. So New Start shouldn't be considered as an early retirement or an easy haven for people finishing work early. Look at a case study. We'll follow Norm and Fran over a couple of different situations in their life, or a procedure progress, I guess, as you will. We've got Norm, who's 57, and he's permanently unable to work because of medical conditions. Now, his wife Fran is 51 and she's not working. So Norm has seen his doctor, and his doctor said, look, I think you'd probably meet the requirements for a disability support pension, but obviously he needs to fill in the forms and get the doctor's report and get an assessment done to see whether he meets that 15 hours a week or less ability to work. Now, his wife Fran, she might qualify for New Start if she decides that she will comply with the activities of looking for work. So the number of jobs she's expected to look for will be determined once she is interviewed, to look at her situation and what her skills and qualifications and so on might be. When it comes to starting on payments, there are some payments that have delayed start or they may have a reduced payment for a particular period. Now, the first one, the compensation preclusion period, that applies to all pension and allowances. So that's generally if a lump sum payment of compensation or damages is made, that includes a component for economic loss, so future loss of earnings. Seasonal work preclusion period, so some people may earn a higher amount over a short period with seasonal work, so that could mean that they have to wait a period of time, but it doesn't include age pension in the group of payments that affects. Income maintenance period, that applies to all payments except for age and carers, and I'll talk a little bit more about that shortly. The 1 week waiting period, so that's for allowance payments, and a liquid asset waiting period, which again is for allowance payments only. So the liquid assets waiting period, as it seems to indicate, it's relating to how much you might have in available funds when you come in to claim for an allowance payment. If you've got less than the threshold, then it doesn't apply to you, which is $5,000 for a single person and $10,000 for a couple. Now that's a higher threshold than it used to be, but there's a temporary relaxed threshold for a couple of years up until March next year. So if you have liquid assets above those limits and you're claiming an allowance payment, you'll have to wait a week for every $1,000 an amount over those thresholds, up to a maximum of 13 weeks. And it commences from the date of unemployment or cessation of study or sickness. Liquid assets, as I said, anything that's basically available funds or easily transferred to cash. So money in the bank and shares, term deposits, etc. If you have an account-based pension, it's the balance in that fund is considered a liquid asset. And payments made by former employer. So it doesn't include, though, funds that are sitting in accumulation superannuation. The income maintenance period, and this can be one that might affect some employees who may have been with the same employer for many, many years and perhaps finishing work early maybe because of illness or redundancy. Any termination payments that they get are treated as income for the duration of the period that they represent. So including annual leave, long service leave, and from a couple of years ago, we started to include redundancy payments in that as well. So irrespective of what is done with those payments, this income maintenance period is applied. So the idea behind redundancy payments, I guess, is they're meant to financially assist people while looking for another job, and they shouldn't be accessing pension or other allowances for that same period. So again, this doesn't affect people who are coming up to age pension or claiming for a carer payment. Coming back to Norm and Fran and their situation, when Norm finished work, he received a 9-week long service leave and a package equivalent to 20 weeks pay when he left work. So that 29 weeks of leave payments and payout package means that they have to serve a 29-week income maintenance period before they can be paid New Start and disability support pension. Now, it does depend on the rate of pay that Norm gets. If he's on a lower rate of income and they don't have any other income from investments, etc., Norm may possibly receive a part disability pension during that income maintenance period. But most times, the amount received from leave is too high for a person claiming New Start to get anything during that period. So Norm and Fran are thinking, well, we've got this car loan and we'll be able to use those payments to repay the car loan, but they need to be careful that they still have enough funds to take them through to the end of that 29 weeks unless they plan to access funds elsewhere, for example, from their super. There are some provisions that allow if something unexpected happens or something unavoidable or out of their control that reduces their funds, that this period can be reduced under hardship provisions. So the waiting periods, some run side by side, like the liquid assets waiting period and the income maintenance period. So once the income maintenance period finishes, then in most cases they can go on to payment, and then at that point it'll depend what income and assets that they have as to what rate of payment they're on. So we'll move on to what income and assets are and how they are assessed. Types of income include gross earnings from employment, and it does now include funds that are salary sacrificed to super. Previously, people under pension age didn't have their salary sacrifice to super amounts included in our wage assessment, but they are included now. We always included anything that was salary sacrificed to other items like cars and laptops and mortgages and so on for some people in certain industries. Income from overseas is generally the gross income counted from those. There may be some exceptions if there's some pensions paid because of restitution, war crimes and so on. Income streams and superannuation pensions, and I'll talk a little bit more about that shortly as to how much income might be counted from those types of pensions. Rent from real estate, that's the net rent after allowable expenses, very similar to what the tax office allow. Rates and insurances and maintenance and interest on loans, for example. Farm or business income, again, it's the net income after allowable deductions. And there are a few differences in what under the Social Security Act are allowed compared to the Taxation Act, but you know, there's a fairly high percentage of similar deductions allowed from those sources. And then there's the deemed income on financial investments. Now, deeming was the set of rules, as I said, that came in towards the birth of the FIS service 20 years ago. Well, actually, we were FISP when we were started, the Financial Information Service for Pensioners. So I'm very happy that we actually changed to be for everybody, not just pensioners, because it's a bit of a tongue twister there. The deeming rules basically look at financial investments in a certain group, like bank accounts, shares, managed funds, loans, etc. They're all aggregated, and then a certain rate of interest is assessed up to a threshold, and then a different rate of interest is assessed on any amount above that threshold. Now, the deeming rates since March last year have been 2% up to the threshold, and the threshold depends whether you're a member of a couple or single, and it's been 3% above that. Some of you may have heard that they are going up next week. We didn't sort of get it in time to be able to change the presentation, but it's going up to 3% up to the threshold and 4.5% above the threshold from the 20th of March. So that's the interest or the return that Centrelink assesses on those investments, irrespective of the actual return that a customer is earning. When it comes to assets, we look at pretty well everything of value that people have. Things like motor vehicles and boats, caravans, furniture, jewellery, personal effects in your home, bank accounts, other investments. If you've got an account-based pension, if you own real estate apart from your home, other things of value like farms and businesses, antiques and collectibles, and excess gifts. So if people have in the last 5 years, for example, made gifts over the allowable limits, then those excess amounts are still counted as an asset for 5 years and are included in the deemed income aggregation. When it comes to valuing these assets, we look at the net market value, so not the insurance value, it's what you would get if you needed to sell that particular item. So it's your best estimate. Sometimes if people have no idea, we can look up the Red Book car valuations, for example, to give them an estimate for motor vehicles. Real estate, again, current market value. If need be, we will get a valuation done by the Australian Valuation Office. But again, initially, we just ask customers for their best estimate of what they think that property might be worth. Financial investments, so it's the current value or the account balance of those investments. Some exemptions to the assets, your own principal home and up to 2 hectares of surrounding land as long as it's on the same title. There was a change to rules in 2007, I believe, that meant that for people of over pension age could possibly have a larger amount of land exempted as long as it was all on the same title as their home and they'd lived there, again the magic number, more than 20 years, and they were using the property effectively. So some people are now able to get 20 hectares, 50 hectares, whatever it might be, on the same title as their home exempted if they meet all those criteria. Other exempted assets, things like funeral bonds up to certain limits, prepaid funerals, funds that people might have contributed to a special disability trust. That was something that was set up a few years ago to allow particularly older carers to set up perhaps disabled children that they've been caring for throughout their life, so that they would be cared for financially when they were no longer able to care for themselves. So it meant a relaxation of gifting rules for money that was, certain amounts of money that was put into those trusts. If you'd bought a complying income stream product before either 2004 or September 2007, then if they were a complying product, they had either a 100% exemption or a 50% exemption from the assets test, depending on the purchase date. And if you're under age pension age, any funds in accumulation super are exempt until you do reach age pension age. There are thresholds that go up on the 1st of July each year, so assets up to those thresholds don't have any impact on payments, and the thresholds depend on whether you're a homeowner or a non-homeowner. So these are the current figures from the 1st of July last year, and we will no doubt get some new figures from the 1st of July this year. So a couple, for example, homeowner couple, assets up to $252,500 means that the assets test doesn't impact on the person's payment. If you happen to have assets above those thresholds for New Start, it means that there's no payment made whatsoever because it's a cut-off point, whereas for pension payments, it just means that there's a gradual reduction in pension payments if your assets are over the relevant limit. The pension reduces by $1.50 per thousand above that limit. Once your assets get to a certain point, then there's no pension payable. Again, the pensions are getting a CPI rise, or an indexation, I should say, more appropriately, from the 20th of March. So these figures will be slightly higher from next week. But at the present time, a homeowner couple can still get a part pension under the assets test if their assets, apart from their home, are less than $928,000. Back to Norm and Fran, see what they're up to. Norm's got $450,000 in his superannuation fund. Because he's over 55 and permanently retired, he can access those funds if he wants to. Now, currently, they're an exempt asset until he turns 65 because he's got it still in accumulation fund. So even though he can access it, as long as it remains in the accumulation fund, it would be exempted. His choice is he could move some of it or all of it into an account-based pension, but if he did that, it would then lose its exempt status, and that would put him in the assets test scenario, and Fran's New Start allowance would cancel because it would take their assets up over the $252,500. Talking about account-based pensions, as I mentioned, the account balance is the asset, so if Norm converted the whole amount of his $450,000, that whole $450,000 would be an assessable asset to start with. The income assessment is more beneficial. There's a formula that we use to work out that so much is considered a return of capital each year, and that's called the deductible amount. So the gross pension less that deductible amount is what we actually count under the income test. So it's the original purchase price minus any lump sum commutations divided by the life expectancy factor works out what that deductible amount is. Now, if it's a reversionary pension, we use the life expectancy factor for the younger member of the couple. So for Norm, he gets a little bit of advice. Maybe he comes in and talks to a FIS officer. He decides to move half or a bit under half of his super, $200,000, into one of these account-based pensions and takes out a pension of $10,000 per annum. So normally he would have to take his minimum 4% out of there, or 2% up until the end of June this year. So he decides to take a nice round figure of $10,000 for this first year. So we've got an asset of $200,000. Now with the rest of their assets, they remain underneath the $252,500. So Fran's still able to maintain some New Start allowance. The income that's counted is the $10,000 gross less the deductible amount, and the deductible amount is $200,000 divided by the life expectancy factor for a 57-year-old male in Australia, which at the moment is 25.2 years. So that deductible amount of $7,936 will remain throughout the life of that product in Centrelink's assessment, unless he does take out a commutation from that product in the future. At that point, then a recalculation is done and the deductible amount is reduced. So that amount of income, that $2,064, It only works out to be $80 a fortnight income, which is under both the limits for Fran and Norm to get the full pension and full New Start if they've got no other income, or if they've got very little other income, for example, from some deeming on bank accounts perhaps. One of the other products that can assist people at various stages of their life are the concession cards. With the pension payments, people are issued with a pension concession card, and that's the one that gives a wide range of discounts, mostly health, so the prescriptions, etc. Some doctors' bulk bill and some other medical costs could be reduced if you've got that card. And it also has available some state and federal subsidised concessions, things like rates and electricity, registration, and the usual, buses and ferries sort of discounts. A healthcare card is one that's available to people who claim an allowance payment, so it's automatically issued, but it is possible to get that card under the low income guidelines that we have, and that's one that can be quite popular for people coming up to retirement age who perhaps finish early, and they might start their account-based pensions early, and they realise they're not going to be getting any sort of other support for Centrelink perhaps until they get to pension age, so they are just looking for something to help out with some costs on prescriptions. So that low income card, I think for a couple at the moment, if the income is underneath $753 a week, and we look at an 8-week period, the 8 weeks leading up to when the claim is lodged, so if people haven't worked in that 8 weeks, there's no income from wages, it just may be something, their investment income, to look at. So many people qualify for that low income healthcare card, it's not assets tested, and then in Queensland it does then allow them access, if they are over 60, to a local seniors card, the Queensland seniors card, that can give them some of those other discounts a little bit earlier, like registration and electricity discounts, etc. So different states have different seniors cards with different rules. I'm not aware of what they are in other states, I'm sorry. A few years on with Norm and Fran, 8 years on to be precise. So Norm is now 65, so he's just snuck in under the guidelines to be pension age at 65. So at that point, the remainder of his superannuation becomes an assessable asset. Now, during that 8 years, Norm's had his allocated pension. Now, they might have wanted lump sums for some capital items during that time, and instead of taking it out of the allocated pension, Norm might have decided to take the odd lump sum out of his accumulation fund. No income is assessed on the money coming out of accumulation. It's just where it goes is then perhaps increases their assets and so on. So if they decided to take a bit of a holiday, they might have taken the lump sum out of the accumulation and preserved the deductible amount in the income stream during that period. So unsure how much Norm's got in there, but presumably on top of that asset, on top of what he's still got in the account-based pension, takes them over the asset threshold, and Fran's New Start is cancelled at that time. So she then looks at claiming a healthcare card and giving her a little bit of assistance until such time as she turns pension age herself. I mentioned the call centre before, so we've got a number of call centres depending on the assistance that people are looking at. Particularly the employment services. These days a lot of the claiming for New Start allowance is done over the phone, and no sort of claim forms themselves to complete, and then people are asked to come into the local Centrelink office to provide some of the verification paperwork when most of the hard work's done over the phone. Also disability carers, retirement, family assistance, etc. So a number of calls. If people are looking to contact the Financial Information Service, we ask them to contact the retirements line. They may be able to be put through to an FIS officer straight away. If they're not, then a message is taken and their local FIS officer will contact them as soon as they're able. We're into modern days these days, and we've got online services that are building now. They originally were mostly for people on New Start and so on, but they're also now available for people on other payments, including age pensions. So people can have these services either telephone or online. People obviously need to register and get a secure password and so on, and they can do quite a few things these days. Check the details that Centrelink has got recorded for them on income and assets. They can check the details of when the next payment is due and how much it's going to be. Also, some claims can be done online. Age pension now can be claimed online, and it's a benefit that way. You only have to fill in, like the tax return online, you only have to fill in the parts that apply to you, so you don't have to tick and flick some pages that you might do with the paper one. And make requests for duplicate cards if someone's lost their pension card or they want a statement showing what taxable payments they got the previous year. So lots of other options for people to do online services these days that can give them a prompt service. So very easy, centrelink.gov.au.